Welcome to your Innovation Coffee Break. I'm Vijay Rajendran, Head of Corporate Innovation at 500 Startups Ecosystems Group. We'll be joined on these Innovation Coffee Breaks by some of the most interesting people in the venture landscape, including investors, founders, and some of the people who are seeing the future. And I'm so excited today to be joined by Alex Marquez of Experian Ventures. Alex, welcome.
Thank you. Thank you for having me, Vijay.
You've been at this for some time. How long has Experian been investing in startups?
Ironically, sort of formally, when I joined, so just over 3.5 years ago in September, 2016, but they had made like one or two small investments prior to my arrival. It's kind of born out of the fact that they saw an interesting opportunity in Southeast Asia and another one in North America, but they were not organized or architected for doing venture investments. They're a much heavier M&A shop. They've done like 100 acquisitions over a 10-year time. And so they wanted to formalize the program, and that's how I came on board. I was recruited to build it out, but it was very much a clean slate, but heavily influenced in one way or the other from an M&A perspective, which I had to not rewrite, but refocus the way you do venture deals as opposed to M&A.
Now, Experian is known as one of the big three credit bureaus. Why are you investing or partnering with startups?
Yeah, it's a great question. Part of it's been driven by just the broader innovation happening in the financial services space, right? I mean, fintech is a grossly overused word. But back in the day, disruption in the banking space, disruption in payments, et cetera, down the line, they're impacted in one way, shape, or form, right? So whether or not you're building a PFM and you got to pull a credit on an individual, or somehow, form, or fashion, you need to do analytics against a bunch of data sets on an individual, they were continuously seeing the disruption happening. And so part of the thought was, how do we get closer to the startup or the venture ecosystem that's sort of creating all this disruption in the broader financial services ecosystem? And obviously one way to do that is through the innovation work that they have with their innovation labs and the data labs. But the other part of that is to get more formally close to them as an investor. And the logic there had a couple of different angles to it. One was, can we bring something unique to the table as a strategic investor? And can we add value because we are a broad organization with footprint in North America, APAC, UK, Europe, Latin America, et cetera. So could we help them scale more broadly as a partner? And so I think the back end logic to that is, if we can, why wouldn't we invest to, in theory, sort of take advantage of their success on the upside? So that's kind of the logic in it. And it was also for the executive team, the C-suite of the company, to get a different level of view on innovation coming from a startup perspective and a VC perspective, as opposed to hearing what the business leaders were telling what was happening in disruption in the space, right? Because you tend to get slightly different lens from someone who's running a particular product group versus folks in the field meeting a bunch of very interesting disruptive companies that you never thought would be doing, particular piece of innovation disruption. So I think it was also very helpful to the executive suite to have a different view on the startup landscape.
There are a lot of people who ask, is it really that different to go out and meet startups versus just reading about them, looking at the analyst reports, maybe attending a conference once in a while? What do you feel is like the texture you get from being an investor in startups?
Well, I think there's a bit of marketing fluff that you can obviously work your way through when you hear about companies doing certain things and you read about them, because obviously their intent is to get awareness in the marketplace and get people attracted to them as a business. I think the benefit of being an investor is that you spend the time to dig deep, because you're doing a ton more due diligence. You're putting capital at work, you're putting brand and reputation on the line, right? Because you're publicly disclosed as an investor. So I just think it's the subtle nuances of detail you get into. But on top of that, you're getting to know management, right? Are these people of credibility that you would back because you think they have the vision, they have the wherewithal to go, disrupt something or build something creative? But also, as you get deeper and deeper in that, right, you're starting to think about, through the lens of like Experian as a strategic investor, how can we bring value to the vision of this individual, right? What are they doing? And you'll quickly vet out, like, hey, look, there is a way for us to work together or not. And if there is a way for us to work together, then you can start shaping the narrative and the conversation around, well, maybe we could be an investor and then also a partner, and we together can bring this product to market, or we can help accelerate or boost your growth in different regions.
That's super interesting because from the surveys that we've done, that tie-in between distribution and what a startup is trying to build, and of course what a large company can offer in terms of its access to the market is like the number one thing, head and shoulders above the rest that startups want, and of course like big companies can offer. They just need to be organized to be helpful there.
Yeah, I think there's that saying, I can't remember, it might have been Andreessen, that said it's kind of a race between the startup and the incumbent, right?
Yeah.
It's the startup getting to scale versus the incumbent getting to innovation, right? So, and that's where I think it's a good coexistence, right? And also startups happen to exist for the purpose of complacency in the incumbents, right? So you would not have the breadth of disruption and features in businesses across all spectrums, not just fintech, if you didn't have a vibrant, challenger base out there of fintech entrepreneurs wanting to, disrupt and dismember and completely, decommodify or decouple the entire banking system, for example. So it's healthy, right? And in some way, it's a very good virtuous cycle, right? Because if you get to a certain point, then your acquirer base, right, your buyer pool is very well known, right?
Yeah.
So the problem is that sometimes you get these little segments of the fintech world where you're like, why do we need 500 PFMs or whatever it may be? Why do we need all these solutions? And so it's hard to wade through a plethora of way too many startups sometimes, but so be it.
With that plethora of startups, what stage and verticals are you targeting?
Yeah, great question. So when we came into it, when we set up the program, it was very clear that it was not natural for us to invest in seed stage companies. The amount of effort and time and hand-holding it takes to be effective with a seed stage company is just not something I think is good for big companies. Megacorp trying to influence startup corp, it just doesn't work out. And so we had early conversations, obviously, with 500, where maybe we just partner with folks like yourself and bring the breadth of what we have for features, and so you can go ahead and distribute it to your cohorts and through all your classes that come together. But we would focus more on the Series A, Series B, and later. And primarily, to the point I made earlier, it's easier for us to engage with a company that has a product in market and is looking to scale, because that's where we can bring the most value. Whether or not, to my point earlier about taking them and scaling them in different geographies or building product together, et cetera, et cetera. So it all fits with our focus. And so definitely not early stage, but we've done late stage as well. We're a late stage investor in Grab, right? Because when they got to the point of scale, there's just a lot of stuff we can work with them on their analytics side, given all the app analytics data they capture.
Yeah, Grab is one of ours too, and what a success story for sure. And it's, I think, an interesting example of how what we know as a ride-hailing app is really just a super app of everything today.
Yeah, we talk about the super app, and in those markets, right? Think about it in the context of what we do as a business, where Experian, it's a credit bureau. It's built on these large data sets of individuals and businesses around a bureau. In some of those emerging markets where Grab exists, you don't have a traditional bureau. So how do you suddenly provide credit product or financial product to someone you don't have any history on them? And so the mobile app, and it's been done in Africa with Tala and Branch, all these other ones, they become the proxy for what we say is the credit bureau, because it's quote unquote the alternative data credit bureau. All the transaction data is in there, all locations, everything. So we love that concept. It's interesting that we've partnered with them in that front, but it's very much what we think the future of future credit bureaus, how they will evolve.
Yeah, and those future credit bureaus are most likely to appear, outside the U.S. in fast-growing places like Southeast Asia.
Yes.
For sure. Like, what's forcing digital adoption in underwriting, in thinking about risk? Is it the mobile phone?
Yeah, mobile phone, definitely. I can't remember the statistics. I've heard everything from the ratio of mobile phones to individuals in Southeast Asia and emerging markets is greater than one, right? So I've always said, there was a guy who started Evernote, a guy named Stefan Pachikov, who said that, this mobile phone is the extension of one's person and personality. And since it's a 1-to-1 ratio and everyone carries it with them wherever they go, almost sometimes they shouldn't, That being said, you have so much information that's either collected directly or indirectly and passively that can create such a beautiful profile on that individual. Now, what you do with it, subject to all the privacy laws, et cetera, that becomes the interesting tenet and point to offshoot. But the disruption in the financial services space is that using it for mobile payments makes a ton of sense. Obviously, becomes even more obvious now in a world where shelter in place and contactless payments and what have you, as a result of COVID. But it's become the natural sort of proxy of what I view, and I think it's pretty obviously, right, that is the future of payments in digital money, right? So whether you take the extreme scenario where it's a version of a crypto vis-a-vis a China model, which they're going after, or if you're just talking about the basic payments and the rails, entirely different structure. But having exposure and being exposed, growing up in the US and then seeing exposure in the Southeast Asian markets, realizing that they just completely leapfrog traditional payments and move right to mobile payments. It is very frustrating when you come back to the US and go, okay, pull out a credit card, pull out cash. Nobody does that in the emerging markets. And it's the analogy I would draw back when mobile phones came up and adopted years ago, where they just skipped wireline in a lot of those emerging markets, right? So that's the healthy part, to see how they've just skipped over into digital payments.
Yeah, I can't wait to the day when I don't have to sign for something.
Yeah.
So I
well, even today when I'm going to stores,
yeah.
I said, well, do you have, contactless? They're like, no, you got to put your card in.
Yeah.
So in every time I'm in Singapore, I'm in, Indonesia and stuff like that, it doesn't exist. It does, but you're the anomaly.
Yeah, for sure. With regard to, emerging markets, what are the other frontier markets that are interesting to you because they're in the process of leapfrogging?
Wow. I think would be, Africa, the Africa markets, because I think that to us, although we have not been active down there on the venture side, we've looked at a bunch, and certainly we could add value there. Those are the ones that are leapfrogging, at least relative to the previous leapfrogs in Southeast Asia. And that's mostly because the lack of a traditional financial system, credit bureau, et cetera, and having the mobile app and being able to start from scratch. It feels like you're almost starting from a blank canvas down there and building the infrastructure and the shape of the future. So that's it for, the more front and center stuff right now has been Southeast Asia, some activity now in Germany as well, and UK, just differences there being, regulatory environment around PII, what you can and cannot do. So I think certainly it would be Africa.
Yeah. Yeah, we just need to see more good sandboxes and and of course the connectivity that needs to come together to make that happen. But that would be super exciting to see take shape. The other thing I wanted to touch on was related to SMBs. SMBs have, particularly in the US, been a large and underserved market. I'm curious what opportunities you see there in fintech that exist now.
Yeah, so we made an early bet here in a company called Nav in North America, right? So this is trying to replicate the consumer marketplace, a la, a Credit Karma or NerdWallet or something like that. And to your point, is you can build these direct-to-consumer capabilities for the consumer, but there didn't exist anything for small and medium enterprise. And so we felt there was an opportunity there, obviously, so we invested behind that. I still think there's a lot of work to be done there. There's all the derivative product that comes off there. We've seen a lot of security companies that got started around security for enterprise, which then becomes a potential offshoot to selling insurance around security related to information security. So that has become interesting. In Latin America, ironically, specifically for us, Brazil, we have the largest presence in the Brazilian market. There's been a lot of activity there in fintech for SME. And it's largely, I think, driven by the fact that there are certain regulatory environments with respect to invoices having to be posted on a monthly basis. The account statements have to be provided for on a monthly basis. And so there's been some innovation there to take all that and turn it to a fully digital hands-off experience, to basically giving away the accounting software to all the SMEs, because they can just load up their data and it's all going to get loaded to the cloud so that the state and governments can actually collect it on a monthly, quarterly basis. And so that's been, but again, that's because the construct of what the government's been asking for forced the innovation to move that way. So they moved off all the paper. There's similar stuff happening in India as well. We've looked at some companies there, but I think for SME, I haven't seen any activity, ironically, at least not to the extent in the Southeast Asia market.
Mhm. Uh, India is a really interesting case because of like the unique payment stack that exists there, and then there's been an explosion of innovation. Uh, do you see the data resting in the future with the fintechs or with the tech fins, the like large technology companies that that are also interested in India stack?
That's a great question. I hadn't thought about that one. Obviously a bigger fan of it resting with the fintechs for purposes
Yeah.
of, but you can never downplay the incumbents, for example, right? But it's been real interesting just to see, right? Because in the last several months as well, we've seen the disruption in the digital side of it, right? Because India, for example, and the exposure we have, right? The challenge you had there was you didn't have a traditional digital process straight through. And so you always had to give a wet signature or some sort of KYC. The forcing function was everything, everything shutting down. And so video KYC has gone through the roof now, as we've seen. It's still slow, right? It's small, but relative to where it was at before, it's 400 or 500% just over it was a couple months ago. So that's where the fintechs will take advantage, because the incumbents, they have to try to catch up. They haven't been, fully adopted and fully prepared for a video KYC or a fully digital process.
Yeah, my prediction is the big tech companies, they may try and use their authentication and so forth to KYC, but they won't be able to launch and iterate their products anywhere fast enough. And so
Yeah, that's always the case. Yeah.
they may be buying up some of those fintechs and markets like that, where there are a lot of them, thanks to the India stack.
Yeah, that's a good point.
Also would love to get your thoughts related to CVC. So you've gone on this journey for a few years, having
decades.
Yeah. So what advice would you give to others who are, like, let's say, new to CVC and building out their teams and their units?
Yeah, so my opinion on this is obviously evolved over time, and obviously for context for everybody, it's I was at Intel Capital back 20 years ago, and they've been known for the longest time as sort of the gold standard for CVCs. But since then, the CVC community has grown materially over then, right? So what is the last numbers? Over 20 some odd percent, probably 25% of venture capital dollars deployed now come from CVC organizations or some corporate venture arm. And so that's the first interesting observation there. But historically, there used to be the anecdote of CVCs were sort of dumb money, because 20 plus years ago, CVCs didn't lead rounds, they didn't take board seats, they were very passive. And so the smart VCs would say, fine, if you're not going to lead around, I'll wait, let me run their valuation up and then have you come in for a later round so that you can fill it out, right? So the good thing is that dynamic has changed, because the CVCs have taken more control of their future, their destiny, if you will. So they've stepped up to the plate, they've built the formal programs, and now I don't know how many thousand CVC programs you have out there in the market today. But I think the advice I always give is you got to have a very clear sort of objective as to why you have this CVC program, right? Because I think there's tends to be a confusion around, well, we're doing it for financial return or strategic return. And I've always taken the very simple position that it has to be by default strategic return. Now, inherent in that statement is the fact that, well, then that means, are you not tracking financial return? Well, of course you're tracking financial return, because if you lose money, the CVC organization won't be around very long. So that's pretty clear. So it's implied. But the reason I say that has to be strategic is because if you're a business unit, part of a larger organization that's publicly traded, I would argue that the shareholders of that company, Intel or Google or whatever, they own the shares in that company, not for the return of the venture group. They own the shares in that company for the return of the core business that obviously generates 50 billion in revenue and EBIT, et cetera. The venture returns are minuscule, right? So I think you have to drive it through this strategic angle primarily, with the lens of being fiduciary responsible for the investments you make. And so that's the lens I take on it. Some people disagree with it. That's fine. But I also counter to those same folks who are at CVCs that if you could raise a fund independently, then go raise it. and then you get all the economics, right? So that's why I say you have to drive it through the lens of a strategic, and the rewards would be borne out in share price appreciation, because that it's a business unit within a corporation, and that business unit needs to generate value that gets reflected theoretically in share price appreciation.
And the majority of CVCs are investing off the balance sheet.
Yeah, they are. I mean, that's going to be, and I think the risk there obviously is what happens in good and bad times, right? So we saw CVCs back away post 2000. Those who've been in CVC long enough know that CVCs were pretty big in 2000 and they dropped off, and they ran back up in 2008 and they dropped off. And so the fear, I think, I advised folks was, what's your staying power? Because don't forget, if you take the context of what a VC does is invest in a portfolio of assets over a long window of time. If you don't go into this with a 7 to 10 year mindset, you probably shouldn't start it out to begin with, because you may find yourself having a conversation with your CFO as to, well, we're not going to make any more investments, and suddenly you have an orphaned portfolio, right? And so, but I guess history does show that it is a portfolio. So if you raised a fund and you're out of money in the fund, they would be in, wouldn't have any follow-on capital, although you couldn't probably create an SPV. But so my biggest fear is corporates walking away from being active, and I think that would be very short-sighted. I think you should be more aggressive today.
Yeah, I think that's true. What we see now is COVID is like the fast forward button. So many things are moving forward quickly, leapfrogging even. And so the time to bet on the future is when we know that future could come to us even faster.
Yeah, it's a great quote. I think Andy Grove or someone else said it back in 2000 timeframe that innovation doesn't stop just because of slowdown in economic times. Yeah. Now it continues to go. Now some folks will say, hey, that some of the best companies were started in 2000. Some of the best companies started in 2000, 2009, whatever. That's happened to be coincidence, but I think it does put a forcing function on being more diligent, because I think a lot of people would argue that there was just too much money chasing deals in the last several years, so people lowered their bar because they wanted to get into a deal. Now the forcing function is like, you got to be a lot more diligent about how you place that capital, but people shouldn't think that entrepreneurs are going to be less innovative just because the economy is upside down for a little while. I think they get probably more resourceful at anything, right? So I would argue that you make some of the best investments now, because from an economics perspective, you could argue some of the terms might be better, but I think you could also weed out the companies that had weak business plans, that had showed some weaknesses in their fundamentals.
No, that's a great point. Exactly. So you get a better group of companies to invest in, a lot more quality companies, and certainly the operating environment has brought down costs and maybe even gotten rid of some competition. Yeah,
absolutely. I think hopefully there's more acquisition activity that happens now, and more so by the large incumbents, right, who are watching the disruption come at their doorstep from the fintechs. Right. Yeah. So some of them will be on sale, some won't, but those who are going discount shopping should be able to find a handful of good deals right now.
Yeah. So I guess like one on the final note is, if you can make prediction for this year in terms of like activity, do you see like CVCs trying to keep up the volume, but maybe doing smaller deals and at more modest valuations, or just being like choosier and doing fewer deals, but ones that will like really hit the strategic notes?
Well, I'll reflect first on a little bit of history, the data that we've seen, right? So you go through the data cycles, you look at 2000, you look at 2008, 2009 timeframes, right? So first observation, and this is kind of a memo I shared internally, is that you see a drop off in deal volume, but you see a bigger drop off in dollars deployed. So they may have done 100 deals pre-COVID, but they'll do, and 100 billion deployed. You'll see 75 deals done, but 50 million deployed, for example, right? So there's a bigger drop off in the dollars. I think part of that is fewer new deals being done, but dollars are being pulled back as much because burn's been forced to reduce, and folks are like, not going to deploy too much capital. And I think the existing portfolios, a lot of the VCs and investors are trying to make sure their existing portfolios survive. So that's first and foremost. I'm hopeful that the CVCs don't see a material drop off, right? Because to the point earlier about corporates being in a position to probably be more aggressive right now, they should be more aggressive doing more deals right now, because if they're trying to align and trying to help startups make it through and scale, there's no better option than to get closer to the startup as a corporate. So that's the way we have looked at it. But I think most folks I've talked to have slowed down to some degree, and the varying degrees of slowness has definitely varied. I've heard everything from we're not deploying any new capital right now, and let's say now, to I've seen term sheets pulled, I've seen valuations redone. And so it's hard to say. I just think it's in this moment right now, the noise is so high, the signal to noise ratio is so off right now that the data points are just kind of scattered all over the place. But look, at the end of year, I'm hopeful. I just know, looking back historically, that from peak to peak, or peak to trough back to peak, I think it's historically look like you won't get back to that same volume and dollar amount for at least 2 years, if patterns were the same.
That's very insightful, and thank you for sharing that historical perspective. It's useful for us to keep in mind that this is not going to reverse things. It's a blip, and with things come back. These are markets and they move in cycles.
It's not the end of the world. Surprisingly, after 2000, we're still here. After 2000, 2008 and 9, we're still here. You just gotta muddle through it and get your way through it and hunker down. Hope for the
100%.
best.
Absolutely. Alex, this was a lot of fun. Really appreciate it. Great perspective, and stay safe and healthy out there.
You too. Thanks, Vijay.
My pleasure. Thank you.
Cheers.
Cheers.